Adam, so talking about the big picture related to systematic active equity, could you share a little about the origins of systematic investing?
So our origin goes all the way back to 1985.
What are signals?
We see a signal as an ingredient.
As an Indian investor, when I'm getting an opportunity to invest in these strategies for the very first time, what can I expect from a portfolio construct?
We don't take as much single stock risk.
Can you also talk a little about the team at BlackRock? Are they a replacement to the traditional way of managing money? Hi, and welcome back to our listeners. I'm Rahul Midha, Lead Sales Enablement at JioBlackRock Asset Management, and I have another very special guest with me, Adam Riley. Adam is a managing director with BlackRock and is the head of international wealth platform strategy for BlackRock Systematic and a senior product strategist within the Systematic Active Equity Group. In this role, Adam drives product development, business strategy, and sales enablement and is lead for the SAE Equity High Income franchise. Welcome, Adam. How are you today?
Very, very well, thank you.
Adam, so talking about the big picture related to systematic active equity, could you share a little about the origins of systematic investing, what sparked it, and how has it evolved over the years?
So our origin goes all the way back to 1985. So this year we're celebrating our 40-year anniversary. And in that time, we have a history of combining data, technology, and human investment insight. What really sparked it is client demand. Client demand for something different in their portfolio and a way to combine index strategies with more fundamental strategies and bring together a systematic strategy that can seek to deliver more consistent returns for clients.
Got it, Adam. And you mentioned data and technology, but if you look back from when SAE started in 1985 to how it's evolved over the past 40 years, what has been the biggest change in how these strategies are built and applied?
Well, I think now the amount of data availability is incredible. And really that happened through the digitization of the economy with smartphones, social media, the internet. But now we have so many different types of data that's available. We are really only limited by our creativity and the amount of resources that we have in order to find new data sets, build and rank stocks using those data sets, and build models using those data sets. So really it's the digitization of the economy, increase of computing power that's enabled this evolution to where we are today, where we can combine lots of different data sets, we can combine those in different models, and we have around 1,000 different alpha signals within our models today. So really, it's really evolved since 2007 and continues to evolve and continues to improve as we find new data sets and look to build those into our models.
Adam, so you spoke about data and technology, but if I was to take you back to 1985 when systematic strategies or BlackRock started doing systematic investing, what did systematic investing look back in 1985 and how has it evolved over the years to what it is today?
Yes, well, in principle, it's very similar. We get data, we rank stocks using data, we build models, and we look to diversify our positions and our portfolios over many different securities. But what's changed is the abundance of data and computing power we have today. So back in 1985, if you could rank stocks based on their valuation by a book value to price, or a dividend to price, or earnings per share to price, that was the artificial intelligence of today. That was innovation. Today, you can get this data from your mobile phone. So what has really evolved is the amount of data. So rather than just rank stocks based on technicals, we can understand the sentiment of retail investors by using social media. We can understand the intentions of brokers and the sort of sell side by reading research reports. We can also look at job postings to understand which companies are hiring, and we can look at the jobs that people are hiring for to understand if they're moving into more using artificial intelligence, or thinking about more climate, or thinking about hiring more data scientists. So really, the amount of data that we have today, we can be very creative, and we can build models using these data sets. You can think about foot traffic. You can think about using satellite imagery. You can look at shipping data. So really, we're only limited by our creativity rather than the data sets. So the principles of systematic investing are the same as they were 40 years ago, but our data and our models, they look very different today. They look like 2025 rather than 1985.
Adam, so what I'm hearing is that in principle, the idea of systematic investing has remained the same over the 40 years, but what's really changed is the amount of data that goes into these models, the way these models look at data and make an investment decision, that has evolved significantly over the years. And one very common phrase which we hear in systematic investing is signals. So, what are signals, and how can you give us some examples of signals which were used in 1985? You did touch upon a lot of signals which you might use today, but what was that one example which we might not think has a predictive power when it comes to the world of finance, but it surprisingly does?
Yeah, no, it's a great question. And think about a signal as a way to do a ranking. So we see a signal as an ingredient. So think about a recipe. You need the ingredients. You need many different ingredients. You need the best ingredients into your recipe. But you need somebody to pull that together into one dish or into one model, as we say. So we have signals. You can also describe these as insights, so investment insights. And these are related to fundamentals of companies. So the valuation of companies that we've looked at since 1985, our earliest signals were related to valuation, book to price, earnings to price, dividends to price. And we still use those in our models today because they are very important to rank companies by the attractiveness of the valuation. So in that sense, we rank the stocks from the cheapest, which is the best, to the most expensive. So we rank each company by that metric, and then we have a different data input or a different signal or ingredient, and then we rank by that metric, and then we rank by that metric, and all the different signals then come together to build a model. And essentially what we've done in the recent, I would say 17, 18 years, is that we've moved more to using alternative data, so big data. So think about price data, think about cash flows or balance sheets. That's more traditional data, or what you can describe as structured data. And since 2007, we've been using unstructured data. And this is quite messy data that you need to either get from text and transform text into data. So really what's happened in the last 17 years is that systematic investors can now read. Before, we only had the data, but now we can read anything that's out there because we've built algorithms which can understand the positive words or negative words in text. And similar to the large language models of today, the models have improved. So now we can apply our technology or our algorithms to central bank minutes, to earnings call transcripts, to the news. And we can look to get insight from that piece of text to then rank companies by positive sentiment versus negative sentiment versus positive change in fundamentals versus negative change in fundamentals. So we're still ranking companies, but we're ranking companies using these different data sets.
Got it, Adam. And I think very interesting in terms of, how these models have evolved over the years, from starting with looking at just fundamental data to now incorporating models where you have a lot of alternate data available to make an investment decision. So, but one question comes to mind, Adam, is that when we hear about the systematic way of investing, a lot of times we think that it's a machine driving the entire engine, or it's a machine making decisions. What one is this true, and what is the role of fund managers, or my analysts? Where does the human element of systematic investing come into the picture?
So the human element is from the research side to go out and find new ideas, to find new data sets,
Yes.
work with companies to onboard those data sets, and to be creative, to find the ingredients, in our restaurant analogy. Then there's a human portfolio manager. So researchers work with portfolio managers, and the portfolio managers are the ones who build the models. So we describe the portfolio managers as model architects. They are taking the ingredients from the research team and from our library of different signals or ideas, and for each different market, they are building a model that's relevant for that market or for that particular strategy. So an income related strategy may have more exposure in the model to fundamental type insights related to dividends, quality, valuation, whereas an emerging market model or strategy may have more exposure to more macro and more sentiment rather than focus just on the fundamentals. So it really is that portfolio manager who builds that model, and they're responsible for the ongoing maintenance of that model if new ideas come in, or if the market environment shifts, as we've seen this year in 2025, there's been a bigger focus on the macro. And therefore, our models have increased their weight towards more macro-related insights. The portfolio manager is also there to manage what we call out-of-model risks.
Out of model risk.
So if something happens in the market which the portfolio manager believes the model hasn't interpreted, maybe some news overnight, maybe an M&A, like the model updates every day, but it may have missed this information that's just been released. So the portfolio manager's role is to understand their model, understand what's happening in the market, and then oversee the model to understand if they should be making that change or if they need to make adjustments. We really feel that it's a sort of portfolio manager is a little bit like an airline pilot, where they're managing the different, they're understanding the weather, like volatility. They are making tweaks to the model, but they are responsible for that model. But our portfolio managers don't go and visit companies. They don't go and visit sites like a fundamental or traditional portfolio manager would do. They are really focused on building the model, finding new data sets, working with the researchers, and then being responsible for that end model and for that performance. So yes, humans are very important, but data and technology are more important in our process than a more traditional fundamental approach. And that's why we really call our approach a human-machine team approach to investing, because it really is that combination of data and technology combined with human insight.
Thank you, Adam. So I think data plus technology plus human insights is what's at the core of what systematic investing is. Could you also talk a little about how do you make sure that the models stay up to date and the data which keeps changing every single day? How are newer data sets incorporated into the process?
Yeah, no, it's a great question because the models decay over time as other competitors get that same data, or the inefficiency in the market is no longer inefficient, and therefore it no longer adds alpha to your portfolio. So it's really key to continue to innovate, and this is one of our core principles, that continuous innovation is key for a systematic approach to investing. And it really is that combination of working with the researchers The researchers go out and look to find new data sets, and they try to understand what's missing from their model.
Okay.
And over the past sort of 5 years, what we've been missing is more thematic or more tactical types of insights. And since the pandemic, what our researchers have been focused on is there any sort of more shorter term data sets we can find related to work from home beneficiaries, related to tariffs, related to changing consumer preferences, related to sustainability. So thematics, sustainability have been really key, and that's where we've directed our research in recent years. But it really is a constant evolution. We never stand still. We like to say that today's alpha is tomorrow's beta, because these signals decay, and it's all about continuing to improve the models so we can stay ahead and continue to deliver alpha for our clients.
Got it, Adam. And can you also talk a little about the team at BlackRock, the systematic team? Like, I think you mentioned a lot about, one is the model architects or the portfolio managers, but like when it comes to identifying these data sources, it comes to onboarding these data sets, how does BlackRock think about this?
So we have in the BlackRock Systematic team over 200 people.
Okay.
And we have a combination between markets people and engineers. So really nice blend between more finance and economics related backgrounds and more AI and data scientists, because that gives us this beautiful diversity of thought. So we love diversity, and we love this diversity of thought because you get different people working with different researchers and portfolio managers to build new ideas, to think about that next data set, to work together. And it really is key that that continues. And in recent years, we've gone from just looking at consumer data, so online transactions, web traffic, app downloads, social media, rankings on product databases, to now looking at business-to-business transactions, okay, invoicing between companies. And that, again, gives us different ideas, but it's this real combination between the researchers working with the portfolio managers and vice versa to understand what's missing for the model and then improve that component of the model.
Got it, Adam. Adam, so how should investors look at these strategies? Are they a replacement to the traditional way of managing money, or do they complement these strategies? Like, where does this fit into my portfolio?
So we think about the whole portfolio context, where you can have index, okay, you could have high conviction active management, which takes bigger bets against a benchmark. You can have private markets. And in the past 10 years, we've seen wealth clients or more retail clients start to invest in systematic strategies. So we've seen interest from both index investors who maybe want to take a little bit more risk in their strategy. And we've seen interest from more traditional clients who invest in fundamental or traditional investors moving to systematic. And we really see that that really helps from the diversification of your portfolio, because our strategies don't tend to have big style factor bias in their portfolio. So we don't take big active positions on valuation or on growth or momentum or size or volatility, these key factors. We like to focus on stock specifics. And if you add a systematic strategy that is more based on stock specific risk versus factor risk, yes, it can be a nice diversifier in the portfolio. So this gives us more potential for consistent alpha, and it gives you a different sort of alpha because it's focused on a lower tracking error versus a more traditional investment. So therefore, you're getting both consistency and you're getting differentiation in your portfolio. So we see it as a real complement in the whole portfolio, but it has replaced some index managers and it's replaced some traditional active managers. But we see all types of strategies that can add value in portfolios.
Got it. So somewhere between an index strategy and a very concentrated portfolio is where systematic investing lies. Would that be accurate to say that?
That is accurate. That's exactly how we fit, both from a style perspective and from an active risk perspective versus a benchmark.
Got it, Adam. Adam, and as an Indian investor, when I'm getting an opportunity to invest in these strategies for the very first time, I think you spoke about it very briefly, but could you expand a little on the benefits of these strategies? Like, what can I expect from a portfolio construct, number one? And what should my expectations be in terms of risk management, in terms of, I think you mentioned consistency, in terms of diversification? So what are the benefits of these strategies?
So the benefits tend to be that we diversify our risks across many different securities.
Okay.
So we would own, more than 100 securities in the portfolio. We don't take as much single stock risk. So we don't have a big proportion of the portfolio in one single company. And therefore, if that company underperforms its peers, or something happens to the company's earnings, we're not so driven by that one single company. We have many different securities in there. We also take lower levels of active risk versus a benchmark. So it really is closer to an index rather than closer to a more higher conviction, highly concentrated strategy that may have a 10% active risk against a benchmark. Yep. This is taking, less than 5% active risk, and therefore does aim to be more consistent, and it's also different than the existing strategies that you do have in your portfolios. So it's giving you something different and helping you to have a more complete portfolio that can have different types of drivers of alpha within your whole portfolio.
And I think one of the other biggest advantages of a systematic way of investing is that it's rule-based, so it reduces a lot of human biases which might come into the investment process. Can you talk a little about how these strategies eliminate or significantly reduce human biases?
Yeah, so there is, goes back to looking at behavioral finance, where you have crowding, you have loss aversion, you have herding. So some of our signals are related to these sort of human biases. And we look to sort of bet against some of those biases. So we have signals related to herding. We have some signals related to crowding. And by having a rules-based model, it helps to avoid those sort of biases. And again, by being spread across many different positions, we can again avoid those losses from holding very expensive, highly held stocks that may be held by many other investors, but then could, the share price could have a significant fall if then investors move away from that particular stock in a way. But what we like to do is use the same data in different ways. So we may think that as a stock is getting the attention of investors, that's something that we like. But if there's too much interest, we think that there's some herding that's happening. So you can like momentum, but if then the momentum becomes too momentum-y, then it's a challenge, and then we look to sort of avoid that. So it's all about being, constantly looking at the models, constantly looking at the signals that the models are telling us to navigate different market conditions and make sure that our alphas are right for that current environment.
I think what I'm hearing from this, Adam, is that risk management becomes inbuilt into the process of systematic investing and it aims to deliver about a lot of benefits which you spoke. And BlackRock has been running these strategies globally for many decades. So, how has the response from investors been in other markets, both institutional and retail, to this way of investing?
With new ways to explain how we invest, the process has become more transparent. It's become less of a black box and more of a transparent box. And for wealth clients, they've really started to adopt systematic strategies because it's become more intuitive. Because if we are looking at social media, we're looking at foot traffic, we're looking at online transactions, that's tangible. That's what people do every day. People are creating the data that we can then use to invest in the stocks that they love. And this is making it more accessible to wealth clients, to retail clients, to the end customer. So essentially, we are democratizing systematic investing that was previously only used by the more sophisticated clients, and now it's been used, and increasingly so, by the people on the street, the people who are saving for their retirement, saving for their kids' education, or saving for a new house, or even for a holiday. We really find that these strategies are now being used by more people, and that makes us very happy and very proud of what we've been working on for the past 40 years.
So it's an institutional product which started off initially as an institutional product, but there's been a very strong adaptation of this by the wealth clients, by individual investors for multiple reasons. Adam, to double click on one of these examples which you were mentioning, could you just walk us through any example which comes to mind on how you're using all this alternate data to make an investment decision? So say I'm a portfolio manager, like what would be this one unique data set I looked at some point in my, say, past 5 years, which really gave me that differentiated insight?
I think the evolution of language models.
Yes.
So, taking text and turning that into data and in a way to rank companies has really been transformational in systematic investing. Previously, we couldn't read. We only looked at data. And now we can take any text and look to extract information from that. So we do the inverse of what a large language model does. A large language model generates, so Gen AI, we extract insight from text that's already available. And this helps with understanding fundamentals. So we can read broker reports or sell-side research to understand if a company has a moat around its business by looking at the number of mentions of the word moat in the broker reports. We can also read thousands of reports and understand if there's any themes within those reports. So in a way, a sort of analyst-driven recommendation on particular themes and how that relates to stocks. You can also read central bank minutes to understand the direction of central bank interest rate policy. Are we more dovish? Are they more hawkish? So I would say that the text and the language has really been transformational. And if there's one thing that I would like the audience to take away, is that we were one of the pioneers of using text-based insight in our models. And we started this journey in 2007. And now I have people say, oh, you're the guy who in 2015 was talking about similar technologies than what we have today in large language models. And again, that makes us very proud that we were one of the first movers into this space and have lots of experience in using these types of technologies within our models today.
And I think that becomes BlackRock's moat when it comes to systematic investing, the way they keep innovating and identifying these data sets and using these signals to make investment decisions.
Absolutely. We like to say that we've failed more times than people have tried, you know? And it really is down to that experience and that failure and that passion for us to go again, improve the models, and keep innovating for our clients that really is in our DNA at BlackRock Systematic.
Adam, and are there any certain markets or asset classes where systematic investing works a lot better than, say, uh, you know, other markets? Like, in which markets do you feel that this way of investing works? Like, what are those top factors I should look at before making an investment decision?
Yeah, so it works across every asset class.
Okay.
In the US equity market, it's highly efficient, but there are many, many different data sets that you can get. In emerging markets, there's sort of less data availability, but more inefficiencies in the market. So it sort of balances out and blends. We describe how we track our performance or our skill based on an information ratio.
Okay.
And you've seen that within Asia ex-Japan, which includes China, and India, Taiwan, and Korea, and Southeast Asia, that our models work really well within that. And I would say that there's a lot of data availability in the single markets. Because if you think about a region like emerging markets, and you want to compare one stock versus another stock, you need to get the same data sets. And it may be difficult to get that data set that compares an Indian stock to a Mexican stock.
Absolutely.
So what's important is that in a single country, like China, that we have a 10-year plus history of investing, and India, there are particular characteristics of that market that can help you to build a single country model. Like in India, you have disclosures of mutual fund holdings. You have promoter pledging. You have particular characteristics of this market that you may not have in other markets, and that gives us opportunities for alpha to find those inefficiencies of the market, get the data, and build models that can be efficient. So I would say that, yes, the US is a difficult market to outperform, but we continue to do that because there's lots of different data available. Asia is a key market where we've had a strong history of outperformance over 20 years now. And then the big single country markets like China are now exciting that we can build a model and a strategy for India. We're very excited about that because we think that the big single countries give us lots of data and lots of opportunities for alpha.
And I think that's really exciting for us as Indian investors, getting the knowledge, the learnings, the lessons which BlackRock has carried over 4 decades to 6 decades actually now, 4 decades, to Indian markets where the India model or the India specific insights are something which, courtesy BlackRock, we at JioBlackRock are able to leverage.
Absolutely. And we've been investing in the India market now, for 20 years, but just not in a single country model. And we can take that global expertise and that global talent that we have and apply that to India market. We run what we call a machine learned model.
Okay.
That we call augmented investment management, or AIM. And what this does, it looks to combine different ingredients together, or different signals, into a single model.
Okay.
And this has been really powerful over the last 7 years since we introduced it. And we're looking to build an India-specific AIM model that will be, really exciting to build an India AIM model. But that's really bringing the global expertise, the global computing power, and global data sets, and really bringing that to the India market. So that makes us very excited, and we can't wait to get going.
Thank you, Adam. Adam, if you were to sum up our entire conversation in one line, what would that be? I know it's a difficult question, but I saved the best for the last.
You really did. The power of scale to a very exciting market. Bringing that experience and the scale of BlackRock combined with Jio is, I think it could be transformational. And that's what makes us excited with this partnership. And I think bringing systematic style, investing, data, and techniques to this market, I think could be transformational.
Adam, thank you for walking us through the world of systematic active equity. For Indian investors, this is really the first time we're seeing such a data-driven, technology-enabled approach brought to our markets. And I think today's discussion has highlighted how it complements traditional strategies while offering new benefits. We're excited to see how this will shape investment opportunities in India. And to our listeners, thank you for tuning in. For more information, visit our website www.JioBlackRockAMC.com.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.